FOMC announcement due out at 2 p.m. today should be a big one. And, of course, we are approaching a monetary policy crossing point. There's a trade-off in policymaking where there's a cost of tightening monetary policy and a cost of doing nothing. Ian Shepherdson, in your latest note, you included this chart that shows a cost of doing nothing, not tightening, and a cost of tightening. Where are we in this curve?
Yeah,
are we at the point where we've crossed yet?
We're getting close to the crossing point. We may already be there. Of course, the problem is that you don't really know for sure till sometime afterwards. So you've got to take a bet on the balance of probabilities that actually now it may cost less in terms of beginning to raise rates than it would cost to do nothing, which is the risk of future inflation picking up. Now, I know right now no one's talking about rising inflation in the US, but the labour market's tightening rapidly. The Fed is admitting this and getting nervous about what might happen to wages in the future. And you've got to remember as well that whatever they do today, even if they raise rates today, which they won't, but even if they did, it would take another year or 18 months to affect the economy. And during that period, the labour market's only going to get tighter because growth is accelerating, and some evidence already is popping up that wages are beginning to start moving higher.
Let's go back to the chart for a minute. I just want to pull it up here because how quickly can the curves slope up or down?
Well, this is the thing, that if you don't act when you get to that crossing point, those curves, or the risk of not doing anything, can get bigger very quickly because as you hit those very low levels of unemployment that we're getting not too far away from now, wages can move very fast. And typically, U.S. wage growth goes from 2% to 4%, where the Fed always panics, in about 2 years, which is not very long, given how long it takes policy to take any effect.
Ian, you know, the evidence of wage tightening is still in the anecdotal phase. It's sort of being pulled out sentence by sentence of the beige book. I mean, one of the problems in America has been stagnating median wages.
Sure.
Couldn't we handle a little wage inflation right now?
We need a little bit of wage inflation. Absolutely. Nobody argues that we don't want any wage increases at all. We're running at 2%. The Fed would be very happy if we could get to 3 or 3.25 and stay there. But they've never managed to achieve that in the past. You know, it always goes from 2 to 4, and then they start getting worried. And actually, some of the hard data, like the employment cost index, which is a measure the Fed prefers, but the markets don't look at so much, is now beginning to pick up. And wage growth in that report in the private sector is now nearly 3%.
Why do you think there's such a bias towards looking at average hourly earnings?
Because we get it every month, because it's very familiar. It comes out in the payroll report when everyone's geared up to look at the labour data. But the ECI's quarterly, it gets completely ignored.
Bob, you were laughing.
Average hourly, it's a terrible number.
It is.
Everyone acknowledges it's a terrible number.
It's a terrible number.
It's like a Dow. It's like the Dow. It's a terrible number everybody watches.
And part of it is, you know, there's a mix shift going on, right? So if you're adding workers with lower wages, like the retail industry, that brings down average hourly earnings.
Yep.
Yet people want to look at that on a year-over-year basis and say that that's the rate of change of wages. And it's a combination of wage changes and employment changes. It's just a horrible measure of wage gains.
Where's wage growth right now?
Well, hourly earnings is 2%, but
What's the real number? I got to make some news.
2.5, 2.75, mix adjusted.
Bob?
I'd say it really varies by market. There are some markets where there's international competition where it's still running at 0. There's others where it's up at 4, 5, 10%.